if you want to protect yourself from a collapsing credit system, and the reason it's collapsing is because it's dollars that run it, and it's dollars that are collapsing, and that will take down everything else. If you really think that is a risk, then you have to get into money, which has no counterparty risk at all. And that is only one thing, and that is physical gold. And I think we're seeing this increasingly. Another aspect of this, of course, is the geopolitical situation, where we have Russia, China, building a fortress, if you like, against the follies of the West. China has accumulated an awful lot of gold without telling anybody.
America's alarming debt crisis is once again taking front and center stage again after the credit rating agency. Moody's lowered its outlook on the U.S. government's credit ratings to negative, citing the cost of rising interest rates and political polarization in Washington has significantly increased downside risks to the country's economic and fiscal strength. Dohmen Capital Research points to the 2008 global crisis as an example when gold dropped 31% amid credit tightening, illustrating how a credit crisis triggers a widespread asset plunge, offering a challenging yet opportunistic scenario for informed investors. Alasdair Macleod, who initially worked as a stockbroker on the London Stock Exchange, is a well-regarded financial analyst. In this video, Alasdair Macleod suggests protection against a credit collapse by investing in physical gold, while noting Russia and China's strategic gold accumulation. By 2021, it had amassed a substantial amount, placing it among the top countries globally stacking gold. This accumulation is part of Russia's strategy to reduce its reliance on the US dollar in its reserves. As of June 2023, Russia is holding roughly 2,329.63 tons of gold bars. The World Gold Council's recent reports highlight a significant uptick in gold acquisition by central banks, with a notable 14% year-on-year increase. China's contribution is particularly striking, with its central bank amassing over 2,192 tons. Meanwhile, Alasdair also observes that gold is undergoing a crucial test at the 2,000 level, posing a challenge for bullish banks. It is expected that gold will continue to attract attention, as several banks have been causing ripples of anxiety through the markets. This includes Silicon Valley Bank, First Republic, and of course, Credit Suisse. Now we present the clips of Alasdair Macleod's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
But technically, the gold is looking actually very interesting because having challenged the 2000 level, which didn't suit the bullion banks, let's face it, and the bullion banks saw open interest on COMEX rising, presumably in the far larger market, which is the London bullion market. They will also have seen the same sort of characteristics of speculators getting into the market, buying forward contracts. And I mean, the thing is, you can sort of feel the quality of the speculators. And when they're very poor quality, which I think has increasingly been the case, then you can bang the price. And that's what they've done. It saved that 2000 level. We then had a slight change, and the initial thought about the slight change was interest rates don't have to go up very much more because it looks like, things are improving, whatever the story. We saw 10-year US Treasury back off from the 5%, go back down to 4.5%. Oh, that's immensely bullish. The whole system is going to be all right, so sell gold. That was the initial reaction, which is interesting because for the last 20 years, everybody's been telling us when interest rates rise, that's bad for gold. When interest rates fall, it's good for gold. But gold fell with interest rates, with bond yields, if you like. But then there came a point where, we bounced. So it just shows how the technical moves you're seeing in the market actually got nothing to do with, what we're being told by so-called experts in the market and all the rest of it. And I think that the technical position in the market now looks very, very good because having just backed off from that 2000 level for what? I don't know, fourth, fifth, sixth time. If you look at the moving averages in the chart, they are moving up in bullish sequence. They underwrite the price around about, I think we got down to 1930 or something. You can see that a number of things are coming right. Now, we need to look, I think, at the fundamentals as well. And that is, if you just look at the situation with a debt trap, that there is absolutely no doubt America cannot escape. And America is important because the dollar is the currency every other currency is tied to. they refer to the dollar. If you weaken against the dollar, you have to raise your interest rates. If you want proof of that, just look what's happened to the yen. I mean, they've still got negative rates in Japan. They're desperately trying to suppress bond yields. The yen has collapsed. It's gone from 110 down to 151, something like that. I mean, this is something like a 40% collapse. Why? Because they have resisted the rise in interest rates. So everybody else has to raise their interest rates in order to keep up with the dollar. And this is creating a real crisis. But the problem that we have with the dollar is who is going to buy all the government debt that is due to be rolled over and new debt issued in the current fiscal year, which only started at the beginning of last month. We're looking at 7.6 trillion of debt being rolled over.
Alasdair Macleod voices concerns about banks grappling with potential capital losses, especially long maturity bonds. Bond prices fall when yields rise, so the Fed's rate increases have left banks with hundreds of billions of dollars of unrealized losses on their bond portfolios. Lower bond yields could accelerate a fair value rebound, helping to unwind those losses, Jeff Rulis, senior research analyst at D.A. Davidson, wrote Wednesday. Alasdair Macleod raises concerns about the Fed's diminishing responsibility for safeguarding the banking system's integrity. The Fed's latest biannual report on financial stability paints a picture of a stable banking system that still faces notable near-term risks. While balance sheets of banks, businesses, and consumers look decent, interest rates and falling real estate values are the Fed's areas of concern. Let's get back to the interview.
Well, we do know that banks have got real trouble in terms of bonds with long maturities, or certainly longer than short-term maturities, more than 1 year, on which they've got capital losses. We also know that these banks are facing problems from their loans. I mean, look at commercial real estate, for example. I would say also the private equity industry is also getting into great difficulties because they've basically leveraged up equity investment on the back of low interest rates. And as those low interest rates have to be rolled, it's just made the whole thing completely uneconomic. We've got that problem in this country. And I don't know to what extent it's a problem in America, but I can imagine that the problem is there as well, because the private equity industry is a very, very big industry. So you've got that. People have been sort of quizzing me about, why is the reverse repo facility collapsed? I mean, it's gone down from two and a bit trillion, 2.3 something, down to about 1.2 trillion. Well, I mean, the answer basically is that the money funds have gone for treasuries, the T-bills. The yield is as good and probably slightly better than you can get on the reverse repo. All this is driving money out of the private sector into the federal government, making the economy starved, if you like, of credit. And you can see that, these are conditions which are going to lead towards a collapse in the value of collateral, and the banks are going to have a real problem trying to square their books. I can just see this sort of getting really rather out of control. Now, as to the point about, it's the Fed's job to ensure the integrity of the banking system, that has long gone, but they still have the responsibility for ensuring that the thing doesn't collapse. In sort of between 1929 and 1933, something like 9,000 banks collapsed. That contracted bank credit by over 30%. It wasn't banks actually calling in loans. It was actually banks going bust. When a bank goes bust, that was it. We didn't have the FDIC in those days or anything like that. This is a situation which I think the authorities will be desperate to avoid. Basically, the expansion of bank credit goes pretty much in line with commercial demand and is not inflationary. Now consider the situation with central bank credit. It is always inflationary. Sort of see the difference between the two. I mean, we didn't have any inflation at all until 1971. But as soon as central bank credit untied itself from $35 to the ounce, what happened? I mean, the purchasing power of the dollar started collapsing. And that is entirely due to the change, if you like, in what happened to central bank credit. Having been detached from gold, detaching its value from gold, standing on its own, takes the value of everything down. What we are going to see inevitably is that whether the crisis actually occurs or whether it is avoided, whatever, you're going to see a massive expansion of the quantity of central bank credit. In other words, currency or reserve balances on the Fed's balance sheet. These are liabilities, if you like. They're going to continue to increase. It could well be that central banks go back into quantitative easing, despite the lesson of the losses that they've incurred. Under those, if you're a foreigner, what are you going to do in all this? I mean, you're going to see your $14.5 trillion worth of investment in US equities going down the pan. You're going to see, undoubtedly, with the funding crisis, you're going to see bond yields continue to rise along the yield curve. So you're going to make losses on your US treasuries. And, are you going to just sort of sell those and just increase your bank deposits and short-term T-bills and things like that? No, you're going to take it out.
As national security issues are becoming more challenging, the U.S. is expected to spend more on interest payments on our debt over the next decade than the $9.8 trillion projected to be spent on our national defense. Clearly, the precarious state of banks underscores the financial system's vulnerability. As gold moves higher, the delicate balance between the looming possibility of a banking crisis and the enduring allure of gold as a refuge comes sharply into focus. How do the challenges in the banking system and strategic gold accumulation impact the global financial system? Share your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.